Hi and welcome to the Stockercade's Dividend Assessment Series. In today's video, we will compare the two oil giants Exxon Mobil and Chevron following their fourth quarter and full year 2020 reports. It obviously has been an abysmal year for all companies in the oil and gas industry, with oil prices hitting rock bottom in April. Those companies kept bleeding cash throughout 2020 while S&P announced it was placing Exxon Mobil, Chevron and other big peers on a credit watch list. As expected for the fourth quarter and full year 2020, both companies reported losses. Exxon's EPS in the fourth quarter was negative $4.70 and negative $5.25 for the full year. Chevron's EPS in the fourth quarter was negative 33 cents and negative $2.96 for the full year. But let's find out which of the two wins the crown for being the less risky stock from a dividend safety perspective. Primary scores are: Earnings Payout Ratio. Both companies posted a loss, therefore an automatic score of -1. From a free cash flow point of view, it doesn't look much different, as the company's dividends paid were in excess of cash provided by operating activities. Both score a -1. Return on invested capital: Exxon negative 9.1% and Chevron negative 2.9%, both score -1. Net debt to EBITDA ratio: Exxon 3.5, score 0. Chevron 3, score 1. Operating margins versus industry: with a negative 15.8%, Exxon scores a -1. Chevron has a negative 5.8% and scores a 0. Dividend growth years: both companies are part of the dividend aristocrats, having raised their dividend for more than 30 years. Even though both didn't raise their latest quarterly dividends, from a calendar year perspective, their dividend growth streak is still alive. Therefore both score a 1. Before we go ahead with the scores, please consider subscribing and hit the like button, so that these videos find their way to viewers for whom such information may be of help. And the secondary scores are: 5-year average EPS growth: both are negative approximately 27%, score 0. 5-year average sales growth: both negative approximately 7%, score 0. Average analysts' estimated EPS growth next year: it is no surprise that analysts see a recovery following one of the worst years in history. Exxon EPS growth is expected to be 37.4%, while Chevron 25.2%, both score 1. Average dividend growth past 5 years: both companies have grown their dividends at a similar pace of 3.6 respectively 3.8%, score 0. Dividend in market downturns: both companies have done everything in their power to keep the dividend at least stable. Score 1. S&P rating: AA negative and negative outlook for Exxon and AA negative and stable outlook for Chevron, both score 1. The totals are: Exxon has a total score of 0. Chevron has a total score of 2. Chevron wins the duel, but both rank extremely poorly in our dividend safety ranking with 1 star. Exxon barely got a star. Crude oil prices are now back to levels where both Exxon and Chevron can return to operate at a profit. High dependency on crude oil prices, scarce interest in investing into renewable energy by both companies when compared to peers such as BP or Shell, make Exxon and Chevron at most a hold with a small position in a well-diversified portfolio. Thank you for watching and see you next time.